With all the buzz about the economy softening and inflation finally headed back down to the 2% range, word on the street is that the Fed is going to lower rates in September and mortgage rates are going to drop big time. And maybe that'll happen. But did you know there's also a chance mortgage rates may not change much at all from the Fed cutting rates? The reason for that is that the market has already priced in September rate cuts. CBS News reports on this, saying many experts believe mortgage rates will gradually decline this fall. With the Fed expected to cut rates for the first time at its September meeting, some think that this event may already be priced in. So while the Fed may cut interest rates, many believe that mortgage rates have already responded in expectation of this change and may not change at all with the actual rate cut. Rob Cook comments that if the Fed takes action by cutting rates in September, that will likely have a positive impact on mortgage rates. However, according to him, rates aren't expected to fall by that much because the market has already assumed the Fed will do so, which has resulted in a recent slight decline in mortgage rates. The article continues saying these trends and the predicted start to rate cuts by the Fed are common knowledge. To some extent, they have already been priced in. That's why interest rates fell almost half a point in the last couple of months, Tucker says. So basically, the mortgage rate cut that people are so excited to see in September may have already happened. The thing you have to know is that mortgage rates are indirectly affected by the Fed's actions. And I think many people don't really distinguish between the two. Like when they hear, that the Fed will be cutting interest rates, they automatically think that they're talking about mortgage rates. But that's just not the case. In order to get a better idea of when mortgage rates will or will not go down, really you need to ask what actually causes interest rates to change in the housing market. Now, if you just answered the Fed raising interest rates, it's time you realize that that answer is incomplete. Okay, there are actually several factors at play influencing the rise and fall of mortgage rates. Like, are the Fed's actions one of the key roles in influencing mortgage rates? Yeah, they are. But so are many other things, like inflation, the bond market, market sentiment. Right? These are all things that we need to consider as well, right? And none can be considered outside of the other because they all play off of each other in different ways. Jeff Ostrowski with Reuters explains it this way. The Federal Reserve doesn't determine fixed mortgage rates, but its policy decisions weave into the broader economic picture that informs and influences your borrowing costs. When setting fixed rates, mortgage lenders take the Fed's moves into account, as well as factors like the 10-year Treasury yield, inflation, and investor appetite. In fact, he describes several variables that affect mortgage rates, with the first being the 10-year Treasury yield. All right, now here's what he says about it. Fixed rate mortgages are tied to the 10-year Treasury yield. When that goes up or down, fixed rate mortgage rates follow suit. The fixed mortgage rate isn't exactly the same as the 10-year yield, however. There's a gap between the two. Next, he mentions inflation, saying that generally, when inflation picks up, so do fixed interest rates. Similarly, with supply and demand, he says that when mortgage lenders have too much business, they raise rates to decrease demand. When business is light, they tend to cut rates to attract more customers. He also mentions the secondary mortgage market as a factor. He says that most lenders bundle the mortgages they underwrite and sell them in the secondary marketplace to investors. When investor demand is high, mortgage rates trend a little lower. When investors aren't buying, rates might rise to attract them. So as we're looking forward, to the Fed's meeting in September and all those predicted rate cuts, we have to have in mind it may not end up resulting in those big fireworks we're all hoping for. As we all have this focus on lowering interest rates, it's also important to keep in mind that cutting rates could backfire in a huge way. The Fed is walking a tightrope here, and cutting rates too soon and too low is actually really dangerous. I mean, as much as we all want to see affordability return to the market, and that can happen through falling interest rates, we need to remember what happened in the 1970s. In the 1970s, the Fed responded too quickly and lowered rates as soon as inflation started going down even a little bit. And the result was inflation roared back with even more ferocity than the first wave, and it ended up taking higher than 18% interest rates to finally get inflation back under control. James Hierzik discusses this in his article, Is the Fed Gambling with Inflation? the risks of cutting rates too soon. Because we know that everyone is watching and waiting for a rate cut with the Fed's next decision, right? So Herzig comments on this saying, expectations are high for a 0.25% cut as early as September, with further reductions to follow. However, this eagerness for monetary easing may be premature and potentially risky for the U.S. economy, raising concerns about undoing hard-won progress against inflation. He goes on to discuss what kinds of things the Fed may be risking if they cut rates too soon. The first potential risk factor he brings up is the possibility of reigniting inflation. He explains that lowering rates while inflation is still above target, currently at 2.9%, risks rekindling inflationary pressures. Cheaper borrowing could stimulate excessive spending and investment, potentially undoing years of progress in price stability. He also mentions asset bubbles. What he has to say about that is reduced interest rates often lead to inflated asset prices in stock markets, real estate, or other sectors. The bursting of such bubbles could have severe economic consequences reminiscent of the 2008 financial crisis. He continues with his list of potential dangers. Loss of credibility. Premature rate cuts that lead to resurging inflation could severely damage the Fed's credibility, making future monetary policy less effective. And finally, he mentions currency devaluation. Rate cuts typically weaken the dollar, potentially fueling inflation through increased import costs and disrupting international trade balances. These are definitely things we don't want to see. So while we're all gung-ho about the cutting of rates in September, we need to keep all of these factors in mind. In his article, Herzig warns us that history offers cautionary tales of premature monetary easing. In the 1970s, the Fed's stop-start approach to fighting inflation led to a decade of stagflation. More recently, the low-rate environment following the 2008 crisis contributed to asset bubbles and growing wealth inequality. Overall, the article shares about the long-term effects that rate cuts can have on our economy when done poorly. Herzig finishes out the article stating that the Fed's next moves will be crucial in shaping the economic future for years to come. Now, another thing that's really not considered about interest rates is that they drive affordability. In fact, they are a major driving force to affordability. Just think about 2021. Rates were lowered to 3%, and all of a sudden, everyone could afford to buy a house. Angela Light explains it this way. She says, with interest rates down, the monthly mortgage payment on a given loan amount is reduced, making home ownership more affordable. The Richmond Fed also comments on the subject, saying, all else equal, lower interest rates would lower the monthly mortgage payment and lead to greater affordability. So while many people think of a home's listing price when they think about affordability, lower interest rates will actually lead to greater affordability much more effectively. All right, so let me give you some real-world data, to show you that. You ready? In January 2022, Denton County's median monthly payment for a house was $1,771 a month. The interest rate was only 3%, and the median sales price was $420,000. Now let's compare that to today. If you wanted to get the same monthly payment of $1,771 per month, and you were quoted an interest rate of 6.5%, the median sales price would need to be a crazy low $280,000. All right, the price would need to drop by a full 33%, right? Roughly like 1/3 of its value. Now, as of today, median sales price in Denton County is actually higher at $468,368. Let's take a look at Dallas County. Again, January of 2022, the interest rate was only 3%, and the median monthly payment for a home was $1,328 a month. The median sales price was $315,000. Now, today, in order to get a payment of $1,328 a month, with an interest rate of 6.5%, you would need the median sales price to be $210,000. So that's a drop of $105,000. If anybody happens to be counting, right? And does it look like we're headed that way? No, we're really not. Today's median sales price in Dallas County is $365,000. All right, how about Tarrant County? Well, we know again that in January of 2022, the interest rate was 3%, and at that time, the median monthly payment was $1,379 a month. The median sales price in the area was $327,000. For a monthly payment of $1,379 a month at 6.5%, that median sales price would need to drop by a full $109,000. all the way to $218,000. So again, we're talking, 1/3 of the current value. Now, as of July 2024, Tarrant County's median sales price was a good bit higher at $360,000. Okay, if you look at Rockwall County, you can see that with the 3% interest rate, the median monthly payment was $1,644 per month. The median sales price was $390,000. Again, we know that in order to get that same price in your monthly payment at a rate of 6.5%, the median sales price would need to drop by 33%, or in this case, $130,000 to $260,000. Well, today the median sales price is not even close to dropping that low. It's sitting at $441,023. Next up, we need to take a look at Ellis County's numbers. In January of 2022, your median monthly payment would be $1,593 per month. Your interest rate at that time was 3%, and the median sales price would be $377,923. Now, fast forward to today, and to get that same monthly payment at today's interest rate of 6.5%, the median sales price would need to be $252,000. That's a difference of $125,923. Again, full 1/3 of the price. So how close are we getting to that price in the market? Well, as of today, the median sales price is $419,950. So do you see how much more movement you need in price compared to how impactful interest rates are? In fact, the formula to keep in mind is if you want home prices to match affordability and interest rates, prices need to drop by around 11% for every 1% that interest rates drop. So sure, we all would love to see affordability coming through price drops, but by and large, affordability is driven by rate movement. Interestingly enough, one way to almost guarantee that home prices will go down is by interest rates going up, right? Because interest rates are the largest factor when it comes to affordability. So rates going up means affordability goes down, demand goes down, and thus prices go down. That brings me right into the next thing you need to know, and that's the fact that interest rates also drive demand. Now, if you think about how much interest rates change affordability, it also makes sense that interest rates would drive demand. When interest rates go down, affordability increases, and it doesn't take much interest rate movement to increase by a lot. Like we just saw, a 1% drop is equal to 11% of a price drop. Now, subject to seasonality, all right, buyers are going to enter the market when it's more affordable, and that demand will drive prices up. Something to keep in mind is that there are a lot of shadow buyers out there who want to buy, but affordability holds them back. Millennials and Gen Zers, they're all wanting to enter the housing market. Families who have grown and need bigger houses, retirees who need to downsize. So many of these people are just biding their time waiting for that affordability factor. Plus we have to remember all of the influx of people moving to Dallas in general. According to U.S. Census Bureau data for the 13-county Dallas-Fort Worth metro, net migration resulted in the addition of 101,419 people from July 2022 to July 2023. That translates to about 278 more people in DFW per day via migration. So that is from net migration, all right? But the Census Bureau also shows, taking migration, births, and deaths into account, DFW as a whole added an estimated 152,598 people, or about 418 per day. Now, I will say this, in Dallas, pretty much the only thing that is effective in stopping demand is affordability. If we look at the fall of 2022, we really see that. When the Fed started raising rates, demand and prices dropped off the edge of a cliff. Now, here's another thing about interest rates that I think will surprise you. With all of the NAR changes in full effect now, I think interest rates could affect how the buyer's agent gets paid. Now, I practically see you raising your eyebrows on that one, okay? Trying to figure out where in the heck that correlation comes from. All right, but think about it. Right now, we're in a buyer's market. Homes are on the market longer. By and large, sellers are very willing to pay the buyer agent's commission without question. Right? They don't want to do anything that would set up a roadblock from a buyer considering their home. Inventory's high, and there's a lot of competition for sellers out there. Let's just say there are 5 houses in the neighborhood and 4 of those sellers are paying for the buyer's agent and 1 isn't. Chances are the buyer's going to skip that one. Right? If there are 4 other houses that won't cost him, an extra 15 grand out of pocket, he may not think it's worth it to even view that one. So sellers are taking that market dynamic into consideration. I mean, by and large, they're choosing to pay that agent's commission, which basically is a marketing expense to them. I mean, when the market is soft, you spend more on marketing. Nick Wooten writes how commission offers haven't changed much under the new rules. Most sellers continue to offer compensation to buyers' agents. He even reports about one recent case. In it, a seller offered reduced buyer agent compensation to see what would happen. The home received multiple offers, but each buyer requested that their agents be fully compensated. So if the commission structure can change, all right, you have to ask yourself, well, why hasn't it? Well, Justin Landon describes it this way. He says a larger factor may be the region's softer housing market. Inventory is up, buyer demand is stagnant, and interest rates are elevated. He said it's just not a boom market. So how might this affect how the buyer agent gets paid? Well, higher mortgage rates are making homes unaffordable and less buyers are entering the market. When rates begin to drop, affordability will improve and we will see more buyers enter the market. If sellers begin to have the upper hand, it will allow them to cut back on their marketing budget. I mean, they may not be so willing to pay the buyer's realtor. So much of this is just market dynamics, and interest rates really drive that. Now, if all this talk about buyer agents and how they get paid is just completely foreign to you, I do provide a super detailed explanation in this video, which you may want to watch next. In the meantime, Wendy out.